Government budget and the economy. Budget is an important instrument by which a government of any country can fulfill its different objectives. Classical economists like Adam Smith, Marshall, Pigou, etc. were in the favor of laissez-faire policy. They did not give any importance to government budget for achieving macroeconomic objectives. Professor J.M. Keynes was the first economist who advocated this idea. He suggested that the problem of depression can be resolved with the help of government budget. Thus, government budget is an important tool for achieving macroeconomic objectives like to obtain higher rate of economic growth, reduction in the unemployment in the rate, and control inflation for establishing a welfare state. In this chapter, we will study public and private goods, budget, concept and components, tax, concept and components, types of taxes, government expenditure, classification, types of budget, types of deficit budget, and downsizing, the role of government, meaning and implications. Public and private goods. Public goods. Public goods are those goods which are consumed by all. Generally, these goods are provided by the government for the welfare of the society. National defense, construction of roads, government administration, parks, etc. are some of the examples of public goods. Private goods. Private goods are those goods which are provided through market mechanism, that is, by transactions between consumers and producers. Clothes, food items, cars, TV, refrigerators, etc. are some examples of private goods. Government budget. Definition and objectives. In the words of Richard B. Good, a government budget is a financial plan concerning outlays and receipts of the government. Objectives of government budget. To raise financial resources for the purpose of development. To bring social justice. To maintain stability in the economy. Balanced regional development. Development of basic infrastructure. To encourage savings in the economy. Employment generation. To raise resources for general administration. To provide resources for defense, and to provide resources to deal with natural disasters. Components of budget. There are two components of budget: revenue budget and capital budget. Revenue budget comprises of revenue receipts and revenue expenditure. Revenue receipts can be further classified as tax revenues and non-tax revenues. Revenue expenditure can be further classified as planned revenue expenditure and non-planned revenue expenditure. Capital budget comprises of capital receipts and capital expenditure. Capital expenditure can be further classified as planned capital expenditure and non-planned capital expenditure. Tax, concept and characteristics. In the words of Finlay Shiraz, taxes are compulsory contributions to public authorities to meet the general expenses of the government which have been incurred for the public good without reference to special benefits. Characteristics of tax. Compulsory payment. Absence of direct benefit. Expenditure on aggregate welfare. Personal responsibility. And legal procedure. Direct and indirect taxes. Direct tax. Direct tax is that tax which is actually paid by the person on whom it is legally imposed. The impact and incidence of direct tax remains on that person on whom it is imposed. Income tax, corporation tax, and wealth tax are the sum of examples of direct tax. According to Dalton, a direct tax is really paid by the person whom it is legally imposed. Indirect tax. Indirect tax is that tax which is imposed on one person but is paid either partially or wholly by another person. In case of indirect tax, the impact and the incidence of tax are on different persons. Sales tax, entertainment tax, excise duty and custom duty are some examples of indirect taxes because its burden is shifted by the manufacturer or trader on the consumers or buyers. According to Dalton, an indirect tax is imposed on one person and paid partly by another. Government expenditure. Classification. Plan and non-plan expenditure. A plan expenditure, as the name suggests, refers to that expenditure by the government which it incurs under its plans with approval from the Planning Commission. Non-plan expenditure, as the name suggests, is used to cover all expenditure of the government not included in its plan program. Developmental and non-developmental expenditure. All those expenditure of the government which promote economic growth is called developmental expenditure. For example, expenditure on agriculture, industry, power, irrigation, transport and communication, etc. All those expenditure of the government which do not promote economic growth of the country is called non-developmental expenditures. For example, expenditure on civil administration, defense, pensions, interest on public debt, etc. Real and transfer of payment expenditure. Real expenditure is that expenditure by which we get goods and services. For example, expenditure on agricultural development, education, railways, roads, etc. Transfer expenditure is that expenditure by which there is no increase in income or output. For example, old age pension, unemployment allowance, scholarships and interest on national debt, etc. Recurring and non-recurring expenditure. Recurring expenditure is that expenditure which is done on a regular basis, such as expenditure on security, education, health and repayment of loans, etc. Non-recurring expenditure is that expenditure which is done on irregular basis, such as expenditure on natural calamities, expenditure during wartime, etc. Importance of public expenditure. Increase in the activities of the state. Economic planning. To reduce unemployment, poverty and income inequalities.
Fiscal policy is the policy of fixing its revenue and expenditure in a way that economic fluctuations are minimized. The government affects the level of equilibrium income in two specific ways: change in government expenditure and change in taxes. Change in government expenditure.
When G exceeds T, the government runs a deficit. Since G is a component of aggregate spending, planned aggregate expenditure will increase. The aggregate demand schedule shifts up to AD0. At the initial level of output, demand exceeds supply and firms expand production. The new equilibrium is at E0. The government spending The diagram shows the effects of fall in tax rate T. A cut in taxes increases disposable income. Aggregate demand curve shifts up a fraction C of the decrease in taxes. The tax multiplier is given by types of budgets. There are three types of budgets. Balanced budget. A government budget is said to be a balanced budget if the total receipts of the government are equal to the total expenditure of the government. Mathematically, a budget is called balanced if total receipts is equal to total expenditure. Surplus budget. A government budget is said to be a surplus budget if the total receipts of the government in the budget are greater than total expenditure of the government. Mathematically, a budget is called as surplus if total receipts is greater than total expenditure. Budget surplus is equal to total receipts minus total expenditure. Deficit budget. A government budget is said to be a deficit budget if the total receipts of the government are less than total expenditure of the government. Mathematically, a budget is called a deficit budget if total receipts is less than total expenditure. Deficit budget is equal to total expenditure minus total receipts. Relation between government deficit and government debt. Government deficit and government debt are closely related. The government deficit is a flow concept, but it adds to the stock of debt. If the government continues to borrow year after year, it leads to the accumulation of debt, and the government has to pay more and more in the form of interest. These interest payments themselves contribute to the debt. Thus, deficit is the cause and effect of the debt. Deficit reduction. The government deficit can be reduced by an increase in taxes or reduction in the expenditure. In India, the government greatly relies on direct taxes to increase the tax revenue. Government activities should be made more efficient through better planning of the programs and better administration. Types of deficit budget. These are of three types: revenue deficit, fiscal deficit, and primary deficit.